Good morning. You're listening to Before the Bell, your home for actionable pre-market content. Good morning. This is Chris Buss with Traders Profit Compass with your morning look at markets for Thursday, February 10th. As usual, please run the player at 1.5x. Okay, taking a look at futures. Oil's up 1.25%. Equities are flat ahead of the CPI print at 8:30. Copper's up 2%. Bitcoin's flat. As I mentioned, on the macro front, we've got a big CPI print. I have not looked to see what consensus is. If you've been around me for any length of time, I don't particularly care what it is. All I care about is which way does the market move. So whether it comes in, hot or as expected or cold, that'll give us a read on, market sentiment, which way it may move. Jobless claims, nat gas inventory at 10:30. And then we've got a 30-year bond auction at 1 p.m. And just as a side note, yesterday's 10-year auction was one of the strongest on record. Record amount of foreign buyers at the table, ready to buy. What was interesting, I was watching the TLT, and it, as the auction commenced, there was a big spike in TLT, and then as the buyers stepped in, drove down the yield, causing a spike in TLT, and then they spent the rest of the afternoon fading it. So there's definitely upward pressure on rates, having seen that great auction, and then they push the rates right back up. So we'll see what happens on the 30-year today. That'll probably have an impact on housing. That 30-year housing loan that everybody gets is going to be tethered to that 30-year bond. So we'll take a look at that. Over on the earnings front, we've got Coke, Datadog, Misolor, Steel in the morning. And then this afternoon, we've got affirmed AFRM. That stock has been destroyed like most of that high valuation tech, but it's putting in a good bounce, so we'll see what happens there. Twitter, Cloudflare, and Expedia are the ones that I have of note today, so keep an eye on that. Of course, you can get the calendar at ewhispers.com or look at the summary calendar on the webpage on the blog post. So let's start here this morning with our oscillator, and this is really one of the most concerning things I have at the top of my head today as we enter into this end of the week after having put in a very nice bounce off of the recent lows. And you can see here, and actually sent out a note yesterday talking about this at the close. We had started yesterday, at the upper third of the range, but with yesterday's move, it has now pushed it right up to 60 here. Top end, I'll say the bottom end of overbought, but the top end of the range, you can see here going back. You got to go back to October of 2020 to find a print higher than this one. In all these other instances, it reversed. So if you're long tech, keep it on a short leash and be ready and implement that strategy that we've talked about so many times. Continually rolling up your strikes. You can stay in the trade, but keep it on a short leash. Make sure you go to the bank as often as you can, or as often as is warranted by the movement and the price, because These oscillators, as I've mentioned before, stand undefeated. It will reverse, but the question is it going to be, are they going to push it higher? And I want to show you a chart that I have not shown you in a long, long time, but I want to bring it to your attention. This is what I call my Extremometer put-call ratio chart. And what it shows you is, gives you a read on sentiment and positioning in the market. When there's a lot of put buying, then this chart drops. You can see the green arrows are at locations where the put buying got to extremes, as denoted by this green line. And I mean, you can see this is COVID back here. Other rug pull instances are here. And then this was just, this is January, right here at the end of January. We've got a number of days where a lot of people were buying puts, and that's what people do. They buy puts at the bottom, and then they get squeezed out, and I think that's what's happening now. But notice on our rebound, we don't have the extreme call buying that we've had in all these other instances along the way. So what is my point here? The market character is such that it wants to make the most people possible lose. So think of this as the boat. I talk about it in the blog post this morning. This is when you get these dips or extreme put buying, that's people in the short boat, either by hedging or outright short bets. They're saying, oh, wow, I'm scared. I think the market's going to go down. I better buy puts. And then what the market does, it says, wait a minute, I got to get a bunch of people on the long side before we pull the rug, right? So we've got to migrate everybody from the short side here to the long side here before we go down again. So we've got two competing things on the board in these last two slides that I showed you. Number one, the Qs are getting to extreme overbought, but from a market-wide sentiment, I don't think there's enough people on the long side yet or convinced that this is a durable rally in order for there to be another deep plunge. Could I be wrong? Sure. Happens every day that I'm wrong. But right here, I can't see the market saying all these people are right and going right back down for another plunge. Will I be ready for that plunge? Yeah, I want to keep an open mind, because remember, my thesis right now is this is a bear market rally. Okay? This is what I consider an oversold bounce. Now, as we go higher, that's going to convince more and more people that think like I do that, wow, you'd have to rethink it. The higher you go, you're going to put doubt in your mind as if we can go higher if you're thinking it's an oversold bounce. But that's what the market does. It wants to convince all the people that we're going to go have another plunge, that no, we're going higher and higher, and squeeze out all those shorts. So my approach overall right now is, okay, we've had a bounce. We're moving up into important resistance and Fibonacci levels. And so I'm on a hair trigger from the standpoint of keeping my longs on a leash, short leash, and be ready for that reversal when and if it comes. So that's how I'm approaching it. Now let's dive in and look at where we're at. This is SPY, daily chart, tradable bottom, consolidation, gap up yesterday, and I've since removed it, but there was a gap here from before, from this drop here, and we've come right up to that level, 457.50. We filled that gap to the penny. I put the new gap in from yesterday. So today, I think you can use 57.50 as your pivot. Now, what I want to point out is a couple things. We gapped over the 20 EMA here in blue, and we moved past the 50 EMA. So those are significant bullish technical events. You recaptured the 50. So now price is above all the moving averages. That is bullish. So for today, and you can see in gold on this chart is the 50. We're above it. We've got a $5 gap between 460 and 465. That's the next technical objective, is to come up and fill that gap and move up to 465. Now on the downside, we've got a gap to fill from yesterday. So the CPI print, if there is some kind of dramatic reaction before the bell opens, we could open down here at the bottom of the gap, as a first move, or we may gap higher, or nothing happens. So what I would use going forward, since we're trading above the 50, use that as a line of demarcation, right? Because it's an important line. You can't go up and fill this gap until you're above the 50. So use that as a pivot point on your charts. So if this morning they pull the rug pre-market and you see that support is holding here at 450, remember that was an important line in prior days, and you can see all of this consolidation right along that 450 line. That should be support now. So if you get a rug pull this morning that goes down to 450 and holds, get long with a stop just below. See if you can see if you in the market can fill the opening gap, back up to yesterday's close, and then advance it. That would be, a red to green. You open red, they buy it up, and keep going. A red to green transition. If they go higher on the open, then you've got your locations here. You'll have a gap above, just like we did yesterday, and then proceed to move higher. So I think that's the game plan for this morning on SPY. And this 30-minute chart doesn't add a whole lot, but it's a clearer picture. We've got the gap below and we've got a gap above. So what I think might happen is get a flash move up to fill this gap, and then that would be a potential reversing point. And if you were lucky enough or good enough to get in that trade, whether it's an opening position down lower that goes up higher and eventually makes it to 465, that would be a definite place where I would be going to the bank. And then you can decide, or we can decide, if we want to stay long or reverse short. So that's what I think on that. The Qs, nice technical milestone here as well. Why? The gold is the 200 EMA. And so now we're inside of this gap. We recaptured the 200, and now we've got the overhead resistance being the top of the gap here at 370, and this 50% fib retracement line. So if we can pop that, then that'll open the door up to 375 for this gap here and the 618 retracement level. And if some way or somehow price can get up to 380, which was this big trading range there, I can almost tell you for certain that I would be flipping short there with a stop just above, prepared to be wrong, but hoping to be right at 380. That'll be a 618 bounce that will check off the boxes for filling these gaps. Check mark here, breakdown, back test, fail. That's a very common move. We've talked about it a dozen times or more on these videos. Major level, breakdown, revisit the scene of the crime, back test, and then fail. And I can almost tell you for sure that if we get up to 380, there's going to be a lot of people in that long boat. And I know a lot of people would be squeezed out of their shorts if they're expecting this to go down right away. That would cause some P&L pain, get everybody all bullish right here, and then get rejected. So that's kind of what I see as a potential narrative for the Qs. Here on the 2-hour chart, you can see in gold the 50 EMA coming down. That'll be a level of resistance. Should we break through these levels, you can see we got a partial gap above yet to fill. We've got a layer of resistance at 370. Prior low here, prior low here. That may prove, and we've got a high right here. So 370 is an important level. I mean, you can't get to 380 until you get through 370. And I think this is going to be a really important level here this morning if we get there, because prior high here and 2 prior lows. If you get through 370, I would definitely be long for a move up to 375 and potentially 380. So we'll see how that CPI print and all that kind of stuff affect the market this morning. Here, it's just a blown up view. You can see we gapped up in the morning and made progress inside this big gap above, and we got a little ways to go with 370 being a line of resistance overhead. Moving on to IWM. We're right here at the 50% retracement level, 206. Still very bearish posture. Why? We're below the 200. We're below the 50. And we're below massive technical resistance at 210, which is a line that goes back over a year with multiple touches at 210 that held every time except here. And so this is setting up like the other scenarios: breakdown, back test, fail. Now, could we go in here and fill this gap? Sure. Come back up to the 200, stall there, and then roll back down again. That would be even more bearish. Why? Because you went inside the prior range and then failed, and that would be your bull trap, because everybody that's looking at this level knows how important it is, and then you go inside and then come right back out right after everybody gets long. That would be a pretty good bull trap. So that's a scenario on IWM. Right here, I think today you just use 206 as a level. And really, there's not a lot stopping this from going from 206 to 210 if the market is bullish. Now, if there's some kind of wacky, CPI print where they pull the rug, then you've got this open gap below to fill. And then if we lost the bottom of the gap there this morning, then I think you can be short for a move down to 200 if the market doesn't like that CPI print. Here it is on the 30-minute chart, just a little extra resolution for you. You can see that there's not a lot of congestion in this area. So we continue to move higher here. What you can do, actually, now that I look at it, you got a really nice line of support here on this move from this low. Draw yourself a little trend line going up, and then you can stay long against the trend if you want to keep a nice tight leash on it. At this point, I want to welcome any new guests to the channel this morning. I really appreciate your time checking out the work in your pre-market. I think, or what I strive to do each day is set you up with accurate and objective levels to trade against, along with some market commentary that I hope will be helpful, that you can put into your own narrative if you see fit, and then use those levels during the day to trade around. So if you're interested in that, if you think it might be helpful, please hit the subscribe button and the alarm bell and post notification button, and give me a thumbs up, and certainly leave a comment below. Let me know what you're thinking. If there's a stock or a sector you'd like me to review, certainly happy to do that. I couldn't be more pleased to work something like that up into a future video. And then jump over in the show notes. You'll find two things. One is a link to the blog site where you can drop in your email address, and that way you'll be registered for all my content and get an invitation to our trading room. A lot of aspiring traders in there helping each other, finding a lot of things that, frankly, I would have missed. So it's nice to have multiple eyeballs all working together. And then if you happen to make a lot of money, there's a place to donate to my channel with a buy my coffee link. I would really appreciate that. Help me keep the lights on over here at Traders Profit Compass. That would be great, and I'd certainly appreciate that. So let's move on to Fat Man quickly. Facebook, big rug pull. We made a low down at 215, 216, and now we're bouncing. Keep in mind, you've got that opening range that if you were trading that comes in about 237.50, and then the bottom of the gap comes in around 246. Now, I just want you to understand that this chart couldn't be more bearish, right? Whenever you drop that much for any reason, it's going to leave a mark on the chart. Now, you've probably heard, people stepping in, the valuation, the this, the that, the whole thing. Don't listen to it. I think what you're going to see, if my scenario of, market breakdown, back test, and then fail, this is not going higher in that scenario. And if rates continue to rise and we have that situation, I think it's going to be very difficult for Facebook to just do some kind of big V where it comes down here, hits 216, and then fills the gap to 320. I would be shocked. Now, can we bounce up here and go down? Yeah, that's fine. But usually what you see after a massive rug pull, the best thing that could happen to Facebook is to consolidate, between 215 and 240, build a nice base here over the next few months. Let the market do what it's going to do. If there's, really responsive buyers here at 215, they'll continue to buy, and then you'll get a consolidation, and then down the road, then get the entry into the gap. And so you can trade it as you like. You can try to, trade this range, or you can simply say, that's not my style. I'm going to set an alarm at 245. If it gets there, next month or next year, I'll be ready for it. And so you can kind of pick your style on how you want to approach Facebook. Not much happening in Apple yesterday. We're right where we were, the day before. Consolidating right here at 176. You can see that was a problem back here. You can see it was a problem here. And now we're here again. I've got a line of resistance at 177. So one thing that would get everybody excited is for Apple to get a breakout here above 177 and make a run like up to 180 towards the prior highs. That would certainly go a long ways of convincing people that, hey, this bounce is for real, etc. Because that is a big level. I mean, you can see it here. You can imagine a giant cup and handle here, and that would project, way up there. So, anyways, I think you can be long above 176 and certainly above 177 if you get that breakout. Then just stay long and see what happens. On the downside, I think it's open down to 173.50. This band here has done a good job. And then if you lose 173.50, back down to 172 again. Tesla has a seemingly a pretty big problem right here at 935. I mean, we've been there for over a week. Actually, coming up on a week. Last Friday, or actually, what was that? That was 2 Fridays ago. So coming up on tomorrow will be 2 weeks pinned in this little range. So pretty clear, 935 is your pivot point. And, if you've been trying to trade Tesla in this range, it's one of those cases where you're not really wrong. You're not wrong to be long, but you're not really right either. And you just watch your time decay eat up your short-term options as, nothing happens. So if you were long, you might be telling yourself, hey, we're going to break out, and then it never does. You can not be wrong on a technical standpoint, but be wrong on your options because time just eats you away. And if you're a short-term trader and you keep expecting a breakout and it's not happening, just close your position and wait. And so you miss a $5 move in Tesla. It's nothing. Set yourself an alarm at 9:40 and say to yourself, hey, price has to prove it. You get a breakout there, then you risk $5 from 9:40 to 9:35, and then you're hoping for 1,000. So that might be a way to approach Tesla, especially if you're frustrated because you can't seem to get the breakout working. Let's move on to Microsoft. Opened up with a gap, really spent the whole day consolidating, and then moving up towards the top of the day range. So we got a gap to fill above and an open gap below. I think you can use 310 right here at the bottom of this gap as a pivot point, and then you want to hold the bottom of the gap. You want to see if price can fill the gap and then break out. And you can see I've got a little line of resistance here at 315, and then it gets more substantial up towards 318 and then 320. On the downside, if you were to come into this gap, it would be a place to get short for a move down to 305, and then if that breaks down to 300. And so that'll probably be market dependent. If something comes out this morning, the CPI, and they knock it down and they keep on going, that would be that scenario. Nothing on Amazon yesterday. More or less tried to gap it out over the top, and then they just kind of faded it the rest of the day. So I would continue to use these gap levels as pivot points and guidance. You get a breakout above 32.50. I think you can get 75 out of that, up towards 33.25. And if you lose the bottom of the gap at 3,200, I think you're going to come down to 31.50 pretty fast, and potentially down to the top of this gap. And again, you can decide how you want to trade it. If you're not really an Amazon guy, maybe you just want to alarm 31.12 and say, you know what, I'm not going to mess around in here. I'm going to wait for a $300, or is that 3,100? Let's just call it 2,800. Yeah, for a $300 move, you might be just saying, if that gap breaks, then I'll get short if the market's falling apart, and then look for a gap fill all the way down to 27.75. So you can decide, how you want to play that if you're, an Amazon player or a sharpshooter. Google, gap higher, and then consolidated the rest of the day. Pretty easy pivot point to pick out right here at 28.30. Above, you can be long for a run back up to the top of the gap and the bottom of this trading range. If you lose the trend line and the bottom of the old gap, this is the earnings gap. If you lose that, then the whole market's probably rolling over. So I would be watching this trend line and watching this level here at 27.55. Netflix. This one is very much like Facebook, but not quite as bad. We made a run into the gap, failed at the halfway point, has come back, and is now consolidating. At the close yesterday, made a pop inside of 410. I think 410 is your pivot. As long as it stays above, you're fine, and you're looking for at least a move back to 460. But if it fails, we got a gap to fill below. So I think that's going to be a key level there. Holding 410 today. The bulls certainly want to see that. And if the bears can break it, I would be looking for this gap to fill, especially if there's market turbulence coming out of that CPI print. And then lastly, let's wrap up with the semiconductors. Really, really strong move yesterday. Actually, a strong two-day move. Came right off the 200 here at 270, and we're all the way up, making a run at 290. So $20 in 2 days. If you were long that trade, I wasn't, but if you were long that trade, that's been a rocket ship. So let's look at it technically. Recaptured the 50. Actually, recaptured the 8, recaptured the 20, recaptured the 50. All positive, bullish, technical moves. Now we're running up against resistance here at 290, where there was this big trading range, and that would be if it cannot get through, that would be your classic fail, back test, fail. So it's coming into a important juncture there at 290. Let me see if I can show you the 60-minute chart just for some resolution. Yeah, I've got some prior lows back here at 287.50, and then on the daily chart you saw that 290 right there. So on a $300 stock, I would consider that little band between 290 and 298 as a resistance band, where you could see it, kind of make its way through up to 290 and then have some trouble. So that's going to be a little bit tricky. Certainly not as easy as this has been. You might see a healthy consolidation here right at the top before it decides whether it's going to turn back or advance. So, all eyes on that CPI print that comes out at 8:30 along with jobless claims. Let's see if it's, a benign print, right in line, but then let's see if the market likes it or doesn't like it. But my overall scenario, I'm guarded on the Qs simply because of that oscillator reading. I'm encouraged by the put to call ratio. There's still a lot of people betting on a reversal right now, and I think they got to get squeezed out. Maybe push that NASDAQ oscillator up into the 70s or 80s, get everybody bullish, then pull the rug. So we'll have to wait and see how it plays out. But make sure you go to the bank. Make sure you're not too far out over your skis. Don't get all amped up here at the top of a bear market rally. Keep a short leash on your longs and have a list ready for shorts. You know where my list is, looking at the ARC complex, that when you look at those bounces, yeah, they're bounces, but they're not massive, and they have not taken out key overhead resistance. So if there's going to be a reversal, I think those ones are going to be ripe for a downside move, and plus all the other bubble, high valuation Ponzi stocks. So let's leave it there. Hope you enjoyed the analysis, and I hope you have a good trading day. And I'll be talking to you when I see things of technical significance that I can offer an opinion on. So have a good day of trading. This has been Chris Buss with Traders Profit Compass. Talk to you next time.